And we are live, Meryl.
All right, welcome, everybody. So excited about this particular update. I'm coming to you live from my board of advisors in Florida, where there is currently storm alerts moving into a hurricane. So hopefully, we will have reception on the web for this entire event, but let's get through it so we can get to our most important news updates. This is the Fundability report. So one of the things that we've discussed in the past, it's been a while, but where right now there is when an individual or a group of founders are looking for they're looking for money to build their startups or grow their businesses, there's two ways to do it. There's debt and then there's equity, right? And debt can come in several forms. One is small business loans, right? Using the personal and business credit. The other is off-book loans, private lender loans, loans that may convert into equity if they're not repaid. But the Fed right now is actually doing in their financial stability report, they're looking for capital firms, equity firms, private equity firms, mortgage originators that are private money to weigh in on what kind of debt loads that the borrowers are actually under. When I use the term actually purposefully, because there's what's being reported to the credit bureaus, and then there's all the private money we owe that we're also using what's called share of wallet or wallet share. But wallet share isn't just dedicated to what's on the credit report. For many borrowers, there's hard money loans for real estate investors. There are private loans. There's non-equity debt instruments for growing businesses. And all of these require a certain amount of wallet share. And so this article is saying that the Fed actually now wants to gather data and is asking private equity firms, venture capitalists. Now, it's all voluntary at this point. There's no requirement for reporting, but they're looking to see in their body of business, right? Their book of business, they want private equity firms to say, "Oh yeah, there are debt instruments to the tune of $43 billion for 726,000 borrowers." So right now they're just looking for these high level numbers of how many of these 723,000 are actually encumbered with non-credit reporting debt. So I thought that was fascinating. Be on the lookout. That is not going away because that private debt is consuming for some people a huge portion of wallet share, and they want to create some sort of number or to get an idea of how much non-credit reporting debt is out there. All right. Next, the Fed. We know this one's coming, but the Fed is actually saying that monetary policy is the number one financial stability concern. And so those we didn't even need to predict this coming. They're just stating that we're now the top concerns of 62% of broker dealers in the country, investment funds, et cetera, are saying that they're worried about these monetary policy. And so monetary policy is one of the things that it is. So inflation and monetary policy. I just had the hotel staff come in to try and clean the room. So there you go. So monetary policy is one of the top financial stability concerns, but this is from the perspective of the hedge fund managers, the broker dealers of investment funds, et cetera. So everybody's weighing in on and telling the Fed to be very careful about their monetary policy because it's affecting stock prices, equity placement, and the value of American businesses, right? So More on that. I'm sure that one's not finished as well. Now, here's a big one. This is brand new. Well, it's not brand new to concerns of consumer advocates, but there is a right now. There are four. If you watch the master course and the boot camp, we talk about four major um, organizations who are in charge of collecting what we call swipe fees, right? Those swipe charges, that 3 to 5% that's collected from merchants for every purchase using a credit card, right? And debit card. Well, what's happening is there's a bill that's just come out that would require large banks to allow credit card transactions to occur on at least two unaffiliated networks instead of Visa and MasterCard, and American Express and Discover. Those are the four. So what they're saying is you need to be able to process so there's competing interests, right? So because right now it's almost price fixing, at least according to Senator Richard Durbin of Illinois and Roger Marshall. There's almost price fixing because there's only two major, Visa and MasterCard, and then American Express and Discover are also players. But since it is not required to offer at least two processors for every credit transaction, and imagine you go to your credit transaction, you put it in there. Who would you like to process? American Express, Discover, Wells Fargo, Visa or MasterCard, right? I don't know how they're going to implement it, but it's one more button to push to allow for the lowest amount. Now, this is a pro-business move, well, pro-small business move, because remember, the group who covers all of these costs are retailers, merchants, people who are taking the card in order to be able to do business. Well, that used to be meaningful. Here's the fundability point. It used to be meaningful when cash was a big deal, right? But we've gone so 95% cashless in this society that, but hasn't been a lowering of merchants to costs to process these payments. When it was a privilege to use credit, sure, charge more to use the privilege of a credit card. But now everybody uses credit cards and debit cards. And since everybody is required, the entire system inures to the benefit of using plastic to make purchases. What do we end up with? These high, relatively speaking, 3 to 5% of a purchase for an electronic transaction. There is little to no risk by Visa, MasterCard, American Express, and Discover. No risk whatsoever, right? It goes to the issuing bank or to the borrower. But these prices are really high for these processing fees. So we may watch for that. But these swipe fees may come down, which will put money literally immediately into the pocket of every single business who takes Visa or who takes credit cards and debit cards. So that's a great move because it's pro small business, which is get Fundable's bullseye, right, of our borrower target. So love, absolutely love that. All right, and finally, let's go. Regional banks say they can handle any looming credit hiccups. So last week or the week before, we talked about the tier 4 Chase, Wells Fargo, American Express, and Citibank are all kind of like, hey, we need to be careful, right? There's the credit contraction, like Chase is already going full doc and from their credit lines, et cetera. And the regional banks, and we're talking about PNC, M&T Bank, some of the, what we call tier 2 banks, they're in interviews by American Banker. They're like, hey, we got this, no harm, no foul. We're willing to fund American business and American consumers while the big four, the top 4 tier 1 banks are contracting. So I love it. that's one of the big differences between tier 1 and tier 2 is the ability to navigate, because they're smaller institutions relative to size and asset. They don't have as many terminals, they don't have as much, they can pivot. Even if it's a little bit faster, that's going to be a significant advantage to the borrowers. So we're coaching our students and our clients to that tier 2s have having a great opportunity to make a move on the funding possibilities of tier 1. Tier 2 is logging it all in. So we will talk to you guys. That's it for the Fundability Report this week. We'll see you next week at 3:45 Mountain Time. In fact, today it's 5:45 Eastern Time because I'm in Florida. You have waiting for the hurricane to hit. You have a spectacular week.